Good evening, ladies and gentlemen. Welcome back to Stocks to Buy Live. We are in the midst of an election cycle, a fear of a recession around the corner, thanks to the continued discussions around tariff talks, China. We're going to break down some of the most exciting media that has happened this week when it came to Kevin O'Leary debating Ross Gerber. There were some wild clips. We're going to talk about Mark Carney just talking about how, the European Union and everyone's kind of viewing the new world order, so to speak, when it comes to Trump and restating the entire, basically trade policies we have globally. We're going to talk about the stocks that I bought, sold. Obviously, getting rid of SCHD was a bit of a shocker for some of you, not so much for others. I was shocked at how many of you are actually okay with that decision. We're going to talk about that in comparable to how I see structuring my portfolio today, because it is changing. It is evolving in a way I didn't really think, but usually it's weird because I held SCHD for years, but it's like this build up. And then literally within a snap moment, these decisions happen pretty quick in my brain. They're not things that I settle on too much, too short, or too quickly, but the markets are quite a bit red, right? I mean, if you go across YouTube right now, you're seeing a lot of rhetoric that markets are still overvalued, earnings are still flip-flopping around. There's still a lot of concerns on what's going on and the opinions around if it's good or bad the way this is happening, especially on the back of no interest rate cuts. Also a lot of concern on that aspect of it. So futures are looking a little bit, red, nothing too crazy on the red front, but just a little bit. From my portfolio standpoint, like you guys, if you're as aggressive as I am and you keep cost averaging for the markets to still be down as much as they are, my portfolio is back to all-time highs. And that's mostly just because of capital adding. I mean, our gains were mostly wiped out. It's nice to be back up 8%. This isn't on the year, by the way. This is over the totality since I started rebuilding this back. As you recall, literally over a year ago now. It's been quite a bit of time, man. Time flies. I think back in 2023 of October, I sold off more than half my portfolio for deposit for a condo here in Toronto. And it's crazy to think in just a short year and a bit of time, working very hard, saving diligently, still frugally, that we've been able to get the portfolio back up to 388K. Quite a marvel and a half. Hopefully some motivation for those out there. But we're going to talk about this a little bit more in depth in a moment. But what I want to get to here is kind of the hilarity and the conversations this week that have been riding around if this is going to cause a recession or not. And there's two really awesome kind of combatants here. Ross Gerber, a guy I don't really care about, but I find his conversations lately intriguing for who used to be one of the biggest Tesla bulls that's kind of flipped quite a bit. And Kevin O'Leary, who's completely on the side of Trump, loving this tariff war, thinks Canada should be the 51st state. Really for, a Canadian himself, really falls in line with Trump. But we know Kevin O'Leary's stance. He basically doesn't think 125% tariffs is enough. He thinks we should be doing 400 on China. But listen to when Ross Gerber kind of chimes in here because it gets real spicy.
Steals, robs, and does not play by any rules. I don't think 125% is enough.
Ross, are you convinced by that point? Are you convinced? Because earlier, Kevin,
once again,
I want to hear from Ross now. Kevin, Ross, go ahead.
I don't consider the debate over whether China does things that are bad to American businesses. We all agree with that. It's how we deal with it, which you don't want to answer the question, which is tarnishing the American brand globally. This isn't just about China. You're Canadian, and the Canadians couldn't be more angry at us. Now, I live in California, and the Canadians are like, oh, we're just not coming to California now. And I can't tell you how much money in California we make off Canadian tourism. Now, tourism has gone negative here in the United States from foreigners because it's tarnished our brand the way we're handling it. We're the richest country in the world, and the same small businesses you represent now are getting screwed with these tariffs because they have to pay them. Have you actually talked to all your business owners recently? Because I talk to them every day in my job, and I have over 8,000 clients, and tons of them are business owners. So I can tell you, this is we're about to see dramatic increase in costs across America. Americans have never had things disappearing from the shelves since COVID. Okay, so do you want to have a world where you can't find socks? We're not going to start manufacturing socks in America.
Not wrong.
So it's just we have to start growing up and accepting the world isn't like in 1920 anymore, and like the manufacturing that they want to bring back to America isn't the manufacturing we want.
I know we have to go.
Kevin O'Leary on the
end
end here.
But I have to. I hear you. I know we have to go, Kevin. I'm going to ask you to be succinct in your final point, so don't yell at me. Go ahead.
First of all, let's set the record straight. I have multi-nationalities. My whole family's American. I care about every business I invest in America. You're weak when you say we can't deal with this now.
It's
Be
so
strong and get ready for the fight of your life to settle this issue with China. Cheating, stealing, ripping off American IP. Enough is enough. It's time to deal with it now. Have some backbone, my friend. Show some strength. That is the American brand. That is the American entrepreneur. You're weak.
Yeah, it's funny because when it's coming from a multi-millionaire guy that's arguably a billionaire at this point, right? Like, could you just imagine a small business? You've got 5 to 12 employees and you're looking at prices like doubling, quadrupling, and your people that buy your product are just like, I'm not going to pay it. And like, or they can't even get it because China won't ship it here or whatever ends up happening, right? Like, it's going to be a shit show. And I don't think just saying have a backbone is enough. Again, Kevin's got enough money to put food on his table. When you start threatening food on people, like I said, politics, all are great until they start fucking with the food that you're putting on your table. I'm sorry, if your kid can't eat off your business, it's not one of these things where it's just have a backbone. I'm sorry. It's easy when you've got a golden spoon and regardless of what happens to that business, if it goes bankrupt or not, it's just an aspect of your portfolio. It's different when that's the lifeblood of that person's business. Now, on the other spectrum here, let's flip to the Canadian side of the border because we do have our election coming up. Could have already early voted. We're going to go vote tomorrow, but I like listening to both sides. Forget the stupid debates. They're so dumb. I'd rather just listen to these guys on podcasts. You know, Poilievre's been on some, Carney's been on around a bunch. It's a much better way to get a feel out for their policies and just kind of get a feel out for the person that's going to be running. But this was a really good point right here that I found that Carney was talking about.
I would imagine you speak to a lot of other G7 leaders or G20 leaders. What's the general consensus around American leadership right now? And I realize that you have more restraint and are a bit more or tangibly more diplomatic, but what is the thesis among this group of world leaders around what is going on here? How do they explain it? How do you explain it to each other, or can you explain it to each other? Because quite frankly, here in the U.S., a lot of this doesn't even make sense to us, and this is our leadership.
Well, I think the first thing is to recognize, as I have said, and a number of those other leaders have said, including G7 leaders, is that the system as we knew it is over, right? When the anchor of the system is fundamental, has done a series of measures that the U.S. has done, but also set out a series of objectives, and I'll come back to that, but set out a series of objectives that are just inconsistent with the way the system has been operating for decades, right? Basically since the fall of the Berlin Wall, intensified since then. So you recognize that that system anchored on the U.S. is over. That then leads to how do you react to it? There's partly the negotiation with the U.S., in which you've been focused on, but then it's also how do we deal with each other, which we've also touched on.
So this was a neat point because a lot of people, again, like I was mentioning, how do we kind of come through this new adjustment? Because it's not a small adjustment, right? And it's kind of rocking the world globally. So it's going to be neat to see how the full fallout comes into play, especially on the back of, do we get the interest rate cuts? There's a lot of things that need to happen, I think, to kind of relieve the recession fears. But again, we don't know if we're in the negative GDP yet in the United States, Canada. I mean, Canada, actually, I'm shocked at how well everything has been holding together. We'll get through a few of your comments and questions, but I want to do a comparable on like my investment style and thesis around kind of this market condition, because there's a good chance that we are still heading toward a recession, but usually by the time these recessions are announced, the market's already bottomed. You can't really trade off this stuff, but this is the feel out at all different levels, like from billionaires to politicians to the top where Trump just spews whatever and we try and make as much sense of it as we can. And who folds first is the question. We don't know who's winning or losing because everyone is Trump's, oh, we're getting a call with China. China's like, we haven't called anybody. We don't know what's going on. But I see we're getting into some of the political debates. PP is the real clown, has the same book as Trump, lives equal trash. Carney's a clown. Like I said, I don't want to get into who I'm voting for personally. I honestly feel like this is probably one of the toughest election cycles we've ever been through because the policies right now are so similar in Canada, and I hate what they're talking about. It is not the politician's job to fix the housing market. As much as I hate that they pander to the broke and the people that are whining, oh, it's so tough. Like things are so expensive. I'm spending $5,000 for 4-bedroom, 2,500 square foot home and rent. And I get these are expensive problems, but a lot of them can simply be resolved by you moving. And I know that's a tough pill to stomach, especially if you have family and a foundation here. But the reality is the politician is not going to bring your home price down. And what they're trying to do is going to take a decade or longer. I mean, they can only loosen policies. Pierre Poilievre is like, oh, I'm going to cut some policies. It'll save you $100,000. Who gives a shit? If the house is $1 million and $1.5 million, if you can't afford $1 million home today, $100,000 is not going to help you. And regardless of getting into construction and bolstering the entire ecosystem that collapsed on the back of the pandemic, which caused inflation, which led to higher interest rates, all of this shocked the entire real estate market when you had a flood of immigration coming in at the same time. And Toronto's going to be like New York. Vancouver's going to become a major metropolitan area. Those prices will never drop in half. It just won't happen. It's not going to happen. So, like, you got to recognize that a lot of these politicians, as I mentioned with Trump and all of them, Harris, they're politicians. They speak bullshit. So why do you guys get on a pedestal and divide yourselves up? I can never figure it out. It's like you're making fun of the liberals and it's like you guys are just like pitchforks and rallying for no reason. They're not going to your job, bud. They're not supporting the economy. You're the one paying your taxes. You're the ones that are doing this. Like, relax. Don't make such a big deal out of this. It's just it's just a waste of time to fight over it. I think it's ridiculous. But on that note, let's talk about the investment side of this, because again, I invest purely based off companies, not politics. These companies, I believe, almost operate independently of politicians these days. I mean, Apple's a global, all these companies are global companies. They're huge conglomerates today that are fighting to deal with these tariffs just as much as anybody else. And we're in an interesting time. And a lot of people were asking me and kind of getting into this interesting loop of like, why would I sell SCHD when the purpose of it was to collect dividend income, hold it as kind of this recession-proof ETF, which I'm starting to think it's not a recession-proof ETF. I don't think it's going to be as resilient in this market environment as I was hoping. We're not getting interest rate cuts, which I was using it as an interest rate recovery play because those stocks would have done fabulous if we just got interest rate cuts sooner. And this was a lot of like a building up because I've been like the biggest fanboy of SCHD for like 2 or 3 years now. But when I've just did some comparables, I'm like, where do I want to be in the next 5-10 years and what's going to get me there the quickest, or at least the path of least resistance. And as time has gone on, a lot of people say eventually I'm just going to be like a VT person or XEQT, which I'll get to in a moment. But I just want to talk about the comparables here because a lot of the SCHD stocks are in the S&P 500. The difference is they're just not upper weighted because this is a market cap weighted ETF. SCHD is not a market cap weighted ETF. And I really don't want to upper weight a lot of the stocks that make up 50% of SCHD because they're just not good companies to hold right now. And I don't see them having like, outside of income, they're stable. They're great for income producing assets. I don't need the income and I need the growth. And I just don't think I'm going to get it. And some of you have been saying this is an overvalued ETF. You're buying things like Tesla in here. And again, I get that, but regardless, they're still much smaller positions and they auto de-weight out if they start to underperform. Yeah, I mean, you could lose some growth potential. I mean, earnings right now, if you look back, have been wild on this, right? The PEs around, this is again based off the end of March. So we're already through the April here. So these prices are going to be significantly reduced. But I mean, a 25 PE on a 19 times earnings growth rate is not that bad. That's why I always laugh when people are whining about that things are really overvalued. They're comparing the growth of the market to GDP. And it's really hard to understand if true like market efficiency exists or if we are in another bubble-like territory, but I don't believe we are. I think we can go into a slowdown still, a recessionary event. But when I look at earnings from a lot of these companies that I like, I'm just like, man, if we are in a recession right now, these companies are the recession-proof companies. They are proving to be quite resilient over companies like Pepsi, for example. Pepsi, to put an example, I think only a handful of times in its entire history has dropped over 30%, as much as it is dropping now. So is this a stock that I would run out to buy, trading at a 19 times multiple? Keep in mind, this is growing and trading at a higher multiple right now than Google. Not growing faster than Google, but trading at a higher valuation than Google is. And I just, even at a 30% drop, and if we look like, is this company growing? No, I mean, revenues have been strong. They've been flat, but they remain consistent. This company's brands aren't going anywhere. But how does Pepsi grow over the next 5 years? If we get interest rate cuts, Pepsi could see some growth. If how do they introduce a product that disrupts their entire line to offer a new growth, like without accusation? Like, I don't know what Pepsi can do to bolster this company moving forward. And like, I've been doing this with a lot of companies and just running some thought experiments. Like, they're starting to stagnate. And a lot of these companies, when they start to stagnate, the first thing they do to try and keep money coming through the door is they do dividend increases. Typically they start, this company is doing share buybacks slightly, but nothing crazy. I mean, the share buybacks aren't even that wild. This company isn't doing anything outside of paying a consistent dividend where that's going to be I think the most of your return for a little while here. I just don't see where the next period of growth comes from. We had this great period through 2019 into the pandemic when money printing went crazy, inflation got out of control. A lot of this came from that as well. So, I mean, I'm curious to where does Pepsi go if you're not looking for just the dividend, right? Look at Procter & Gamble. Again, these are super, super resilient companies that I noticed a lot of big hedge funds don't hold anymore. And I've just been asking myself, why are so many funds dumping stocks like this? Now, Procter & Gamble, you can argue, is a recession-proof stock, right? Unlike Pepsi, I mean, Pepsi's got a lot of great products, a lot of food products. I get it. You can say it's recession-proof. They're not going anywhere. Obviously, these brands will be around for a long time. Procter & Gamble, your toilet paper, hygiene, all that stuff. These are great companies, but Procter & Gamble trades for a 25 times multiple today. I'm just saying, and this company isn't growing either. These companies are not growing, yet they're trading for tech-like multiples, right? And this, again, I have nothing against. If I wanted income and I didn't care and I just wanted to cost average into stuff, I get it. These are fine companies. They're great companies. It's just fundamentally in my heart, I'm just like, how does this company grow in the next 5 or 10 years? Somebody tell me. If you love this company and you're collecting the income and you want to get some growth out of it and you want to get market average returns or better, because if I'm buying an individual stock, I want better than market average returns. I don't see how Procter & Gamble does that today, right? I mean, they're starting to stagnate just like Pepsi coming out of that 2021, 2022 hype cycle, inflation, all that stuff. Really inflated a lot of these companies' balance sheets. Prices were able to get jacked up. Pepsi's still getting away charging $6, $7, $8 for a bag of Doritos that I will never buy. I mean, this is just the reality of the market today, right? So I think we're in another lull phase for a lot of these recession-proof companies. I mean, use Philip Morris as an example here. Look at Philip Morris. So this is why I don't I talked about how much I hate MO, like Altria Group, terrible management, terrible investments over the last 5 years. Company continues to raise prices, squeezing margin wherever they can, increasing the dividend to keep people buying, even though it's a garbage long-term hold. It's probably one of the worst companies I've seen fundamentally. I've followed them for years. I've owned them. It's one of the first stocks I bought years ago. I get the tobacco sector, and I'd rather get out of the Western world and buy something like Philip Morris. But how do you buy something like Philip Morris today, trading at a 35 times multiple? It's gone on one hell of a tear. It's up 40%. And look at the growth I'm getting here. Ooh, 7% growth, 5% growth. These are companies people are chasing out of fears of this recessionary environment. But there's nothing exciting about these companies today. They were exciting a year or two ago, sure, like British American and like Philip Morris. These look like cheap companies for the yield you were getting. They were very stable, but today, who's buying these right now over a company like Google? Let me just break down for you how insanely cheap this company is and why I bought so much of it. And it's so easy to iterate with just YouTube alone. Let's just use YouTube as an example. Here's a company trading for an 18 times multiple. Okay, let's compare it to Netflix. Netflix trades for almost a $500 billion market cap today. To put it in perspective, it trades for almost a quarter of the value of Google alone. So Netflix is worth a quarter of Google, which is crazy because if we look, they're generating Netflix for Q1 generated about $10.5 billion. Okay, let's compare that to YouTube. How is YouTube doing? YouTube generated about 8.9, so about 9 billion, so about 1.5 billion less. So let's just to keep this math simple, let's just say they generate almost the same amount of income. So Google or YouTube and Netflix are almost the same value of revenue generation. I bet you if you were comparing the margins, YouTube would be superiorly higher. YouTube must have 60, 70% margins. I don't know how it doesn't. It's purely just a money printing machine because they don't pay for content like Netflix does. I mean, what are Netflix margins right now? I mean, let's just see. Their margins here, operating income, 31%. There is no way YouTube's margins are 31. They got to be way higher. So let's just say because they're making $1.5 billion less, but they're making more margins, let's presume their net income is the same for YouTube. So if you were to put that in perspective, right now, Google is only generating that $9 billion off YouTube, but their total ad income, where their total revenue is $90 billion. So about 1/10 of all of Google's revenue roughly is coming from YouTube. 1/10. And think about that. YouTube generates 1/10 of Google's entire revenue, revenue there. But the entire value of it on Alphabet is less than the entire value of Netflix, right? I mean, how can that make sense? It's worth, Netflix is a quarter of the value of Google. It probably comparable to YouTube, has lower margins, a similar growth rate. I mean, this is why I'm saying Google broke up is worth so much more, because YouTube isn't valued the way it should be. YouTube should easily be able to add 500 billion to a trillion of value if that is what Netflix is able to do on its own. And we all know YouTube is a much better business from a fundamental standpoint than Netflix is. Like, this is just one aspect of their business, let alone the fact that Waymo is expanding. I mean, they're doing what, like a 250,000, they're doing like over 1 million rides a month now. I mean, everything about in the comparables, like when you look at what's going on in the market, it doesn't make any sense. This is why I feel like we're in kind of an overvalued market. That could still be a bubble. There could still be a lot of weird things going on. When you compare Google to even Tesla, is insane. These companies, like, this is why sometimes I like being an individual investor still, when I just recognize now fundamentally something could shift here. I just don't see it happening right now. The earnings were just far too good. The earnings call was amazing. Gemini and all these AI things that people bitch about, yeah, they got to compete, but they're not going anywhere right now. They prove they can still remain strong. So when I look at my overall portfolio here, right, like what I'm trying to do is basically say, hey, like I might as well buy the S&P 500 because it's just going to automatically weight the companies that are winning. Even if that is Tesla, and Tesla remains to be a hype stock for in perpetuity, at least I get the performance regardless about how I feel about the underlying fundamentals. And in the meantime, instead of just buying Procter & Gamble and Pepsi and all the stocks, Procter & Gamble wasn't an SCHD, but just kind of, ab-libbing here, whatever. SCHD, if you took all the stocks in SCHD, would I buy them individually? And for the most part, I wouldn't. I would just rather own them market cap weighted and then look at companies like Google and upper weight them, because Google should be bigger than Apple. It should be the largest company on the S&P. I like Meta. I still like Take-Two Interactive, and I would rather upper weight these stocks than own SCHD and comparable to VOL, because at the end of the day, like I am a total return investor, and I like seeing Google do basically you're getting a 4% basically share buyback with the 70 billion they're reinvesting in the company, plus like the 0.5 percentage point of dividend they pay. And it is way more efficient for me because I don't need to spend the dividends today than having to get taxed on them, right? I'd rather just Google reinvest it into share buybacks, give me a small dividend that I can do with what I want with, and watch the company flourish while it's incredibly cheap. So, like I said, I'm a total return investor at the end of the day. I love dividend income. I get it. It just, for me, doesn't it make more sense to weight my stocks this way? Now, again, if I was in retirement, this probably isn't what I would be doing, because I'd be more reliant on the dividend income. If I needed that cash flow to pay bills and I needed stability and reliability, I would go on that path. But if the market tanks tomorrow by 20 or 30%, that doesn't do anything to me. I'm still like 32 years old. I have an emergency fund. Like I can ride through this for 6 to 12 months. If I lose my job, I can find another job. Like there's many things I can do. So I might as well focus on where I'm going to get the best possible return for my dollar. So over, say, like VDY, which a lot of people were asking me about here, like would I consider selling VDY? And no, because I still want global diversification. And that's why I'm still holding on to XEQT. And over time, as I said, when Take-Two, if these stocks that I hold individually get into places where I think they're more fair valued, or the value proposition doesn't make as much sense, which will come. Like I'm not going to hold Take-Two forever. It is going to be a short-lived 1 to 2 year trade. And I'll probably completely convert those shares into some more Canadian stocks or XEQT and start to continue to build wealth preservation in my portfolio. But SCHD doesn't really give me that in the short term, in my opinion. I don't see wealth preservation coming from just continuing to upperweight lower S&P 500 companies. I could see it in XEQT, but I don't want emerging markets yet. I still see growth in the companies I'm holding. I still think the S&P has some resilience to it. We're in just a rocky market environment. And regardless of what you hold, I still think some of these dividend stocks could be considered more risky. But yeah, I don't know. It is what it is. Sucks they are only starting tonight. Let's see what's going on in here with you guys. United Health way oversold. I'm scared of United Health though, man. I see a lot of people pumping it up, but they dropped 20% for a reason, right? Like they have some kind of health insurance that's coming out that's disrupting them quite a bit. You're also seeing a massive brand shift. Because of, their CEO got shot, dude. Like, if you were working at a company and your CEO got, assassinated, like, aren't you a little worried about the underlying business, especially with the amount of heat the company's gotten? You got to understand, you're buying a business. Past performance does not equal future return. So you do want to keep that in mind and just understand there's a lot of risk at play with where that company sits today. But yeah, I don't know, man. It's crazy. So let's go up to the top here and see what you guys are talking about. We'll do a few Q&As. I do keep in mind we are heading into an earnings season. We'll talk about earnings coming up for next week to see what I'm excited about. Can you show us a magic trick? I don't know. Can I show you a magic trick? I don't know about my cards here. I mean, there's some stuff that I could do, but maybe I'll save a bit of a magic show for next week. I'll tease up a little bit of a magic show for next Sunday. Yeah, I haven't done magic in quite some time. I usually do it for my brother's kids or like the nieces and nephews once in a while, but whew, man, those magic days are now 5 years behind me almost. It's crazy. It's kind of crazy how fast time flies, isn't it? Because I was a full-time magician up till that pandemic, and then wow, here I am on YouTube. Attempted to sell Tesla and toss it all into Google. Honestly, the easiest decision in the world for me. I traded Tesla, made a good game, but buying it here just seems ludicrous. I mean, it'd take 140 years of the current earnings to get whatever, like your full rate of return out of that company. Like, there's just no way for the next 5 or 10 years, regardless of robotics, self-driving, that you're going to see a rate of return out of that company. It could flatline for the next decade, unless something really happens with robotics. But with Elon's timelines, I just don't know how they maintain the value they have. It's a bubble. I mean, it's clearly a bubble. It doesn't mean it can't sustain its value, but I know a lot of people hate me on it. I lose subscribers when I shit talk Tesla, but I'm a Tesla fan. Come on. It's a hard pick. It's a hard pick. You got to still have some value. Well, it's like Buffett, right? It's hard to remain irrational because the market can remain irrational longer than you can remain rational. I want Google in my top 3. Yeah. I mean, the wife and I, it is our single largest stock position next to Take-Two. I've been buying Meta back because Meta dropped enough that it has kind of de-weighted itself in our total portfolio holdings. But yeah, those 3 stock picks to me are our golden ticket to financial freedom, man. I think they're like the 3 best stocks in the market for me right now. And I love that we almost have $100,000 in all of them combined, which is nuts. I don't think I ever would have thought. It's crazy when you have those humble beginnings of like, I just own $1,000 of a stock. And now here I am, like being able to throw 30, 50K at a stock and barely blink an eye at it. I only get humbled when I shouldn't be telling my friends, but some of my friends I like talking about investing with, they're not as big of investors, but when they're like, holy shit, you have $30,000 in that stock. And I'm like, yeah, $30,000 is actually a lot of money. It's kind of crazy. You kind of get so used to it after a while. I can't imagine the millionaires out there. Like, imagine having like $10 million in the market and it drops 10%. You just lost like $1 million in paper value. It's kind of crazy. Crazy. You think Tesla's going to pump before they do robo-taxis? I don't know. Again, Google is the leader in robo-taxis, man. They're crushing it. I don't know why it's not priced in the stock. Now, probably wait for the next big hype pop and then set a stop loss. Probably not the worst thing. Got to wait and see what happens in June. Yeah, kind of overwhelming. I'm deep into Take-Two and still digging over 224 now, but still have orders in for fluctuations. I wish I bought the 199 dip. I saw it. I was going to pick some up and I didn't. I'm still happy with the position, but I still wanted to buy about 5 or 10,000 more, but we'll see. We'll see if the hype for GTA builds in before it actually drops. If it rallies enough into GTA 6, I might take some profit, but we'll see what happens. I want to see it double first. I think it could easily double from 200. So we'll see. We'll see. Do some magic on your hair. Yeah, I had a shower and my hair's a little dried out right now, so it's flopping over. You know what's great? I stopped using gel because I was so worried I had my dad's hair and it was going to fall out. So I realized that instead of using gel, if you just don't dry your hair when you get out of the shower and you just do whatever you want with it, when it does dry, it actually stays moisturized and it stays where you want it. You can just use water as gel. I don't know why no one ever taught me that, because gel kills your hair. I mean, look at how thin this stuff is. My mom's got thick hair. My dad's has kind of balding going on. So, but they said if you keep your hair until you're in your 30s, you should keep it for the rest of your life. And my buddies have lost a lot of their hair, but I still got a lot of it, baby. So let's hope it stays. Kyle, can you talk about how you set up your parents' wealth preservation account? So with my parents' account, like to them, like it doesn't really matter. I wouldn't say it's wealth preservation, because to me, wealth preservation is like you're going to be in a lot in bonds and you're just going to like do the healthy, appropriate thing, which is like probably 60% equities, 40% bonds, maybe some gold. Like when I think of wealth preservation, I think of that. But for my parents, I think of them as somebody in retirement that wants to generate cash flow and they don't care about gold, silver, bonds. They just want to be able to not look at their portfolio, collect a very reliable income, and basically ride that for the rest of their retirement and do that 4% withdrawal rate without touching the equity. And it was really easy because, I mean, we were investing in October of 2023, virtually the market bottom of that last dip. So they saw a wicked upswing very quickly, and they have some growth stocks. My mom's actually still trading with me. She bought some Take-Two Interactive with some profit she took out of the S&P 500 that she had, I think. So she does play around a little bit with some growth stocks in her portfolio, but mostly they just have diverse income, mostly fixated in Canada, but they got U.S. real estate. Like I think they have VNQ in there, which will do much better when interest rates cut, I'm sure. I think it's VNQ is the U.S. real estate ETF. I mean, they've got some like they have SCHD. Like they're just very diversified. I mean, they have some like British American Tobacco, which I'm shocked. I'm so shocked. I mean, when they bought BTI, they bought it with like over a 10% yield, and the stock's up like 40 or 50% since they bought it. MCAM Morgan, like they have a really good diverse portfolio of stocks to produce income. So they're going to see some volatility. They are seeing volatility, but their income is largely unchanged. And that's the whole point of their portfolios, mostly U.S. Canadian stocks with a bit of broader exposure in their tax advantaged accounts. But it depends what you want. That might not be your goal, right? Because for my parents, I just said, how much do you need to generate? Let's get to that goal and then take the rest of it and put it in the S&P 500. And it worked out well for them. I mean, my mom pulled some gains out, bought a car. Like they retired at a good time, to say the least. Duro is down on the TSX like $6. Grabbed. Yeah, Duro is trading at a good value. I'll do a video on that shortly. Though, again, we're still kind of in a waiting phase for, I think, for better news, but I'll do a video on it shortly. They did have some earnings. Not that the company's really generating much. Google should have been down 15% after earnings. Yeah, been up. Sorry, I said that is down. It should have been up like, easily 15 or 20%. It should be at a 25, 30 PE. Easy. I mean, they were getting there for a little while. I mean, Meta was, and then it gave it all up. Charlie Munger said Tesla, that he'd never buy it and never sell it short. I wouldn't either, man. It's like Bitcoin. You'd be nuts to sell it short. They're too volatile, man. That's how you get wrecked. You just be smart enough to trade it when it makes sense if it comes down into value. I mean, now it doesn't make any sense. Tesla needs to get down to $100 before I'd consider buying it at this point. They've lost so much of their growth. Everything for them is stagnating at this point. Yep, sold 4 Tesla and bought some Google instead. Poor earnings. Yeah, I mean, a lot of people seem like the whole market is figuring that out. It's just weird how Google is able to trade so cheaply. It just doesn't make any sense. It just shows you that we're in a very fugazi market. I mean, you look at Palantir, and I get Palantir's a great company, but the multiples are ludicrous when you compare it to other tech companies that generate far more revenue and cash flow than Palantir does. Palantir can't be growing at a 30 or 40% clip and justify its value today, I think. It's hard anyways. If you had to pick one single stock in your portfolio, you'd be going with Visa or Google. Google any day over the week. It depends, though. I don't know. It's hard picking a single stock because it depends on, like, fundamentally Google is going to go through volatility. It's an advertising play. I think Microsoft probably has a more stable, diverse. They're both great companies, but I do think Microsoft, even over Apple, has a more stabilized business because it's mostly, subscription based these days. VFE and VOO is worth putting into both or sticking. I'm going to do a video on this because so many of you guys asked me about it. I actually wrote it on my whiteboard for like those random filler videos where I was like VFE versus VOO, or and just doing some comparables on like Canadian hedged versions of the S&P 500. ENB is absolutely solid. It is also a bit expensive these days, though, too, isn't it? What's ENB trading at these days? I got to do some Canadian update videos. I'm waiting for Canadian earnings before I get into too much of it, but let's just take a quick look on what Enbridge is doing. I like Enbridge over a lot of the oil stocks because it tends to be a little bit more favorable. But again, even its value today is pretty rich, right at 27. But I mean, it was trading at almost an 8 to 10% dividend yield, man. Like some of these stocks were real steals less than a year ago, right? I mean, this thing's rallied up 50%. Like they're not cheap anymore. I wouldn't be chasing them here. That's what I'm saying. Like the market tells you where the deals are when you look at a stock that's going down, but the fundamentals are increasing. And I'll remind you, Google has the second amount of cash next to Berkshire Hathaway. I mean, Google's got a lot of money. They could buy an S&P top, probably somewhere. They could easily buy a lower half S&P 500 company with the cash they have in the bank. What's your predictions on Take-Two? And do you think it's worth pumping more into XDIV with the energy holding? Yeah, so like I said, I'm scared with energy right now. I would be careful with XDIV because I think it's a little bit more concentrated in energy. This is my fear, right? Like if you get in these stocks at a good price, it's fun. But that's why I like VDY because it holds mostly the Canadian banks and it does give me some energy. And I don't mind holding energy. I just don't want to chase it here if I'm putting a lot of money in the market today. And if we take a look, I mean, this stock is like 31%. I mean, comparably, what is that next to, let's say, VDY? Let me just look VDY up quick and just see what because I think energy and financials are mostly the entirety of VDY, but I just want to see what the comparable is to see what my exposure is. Right now, let's take a quick look here. What are we at? Energy is energy's roughly the same. I mean, it's like 29%, so it's a little less. But the difference here too is you got to remember, most of that money is in Enbridge when it comes to a VDY, because Enbridge, it's market cap weighted, right? So Enbridge, which I don't mind holding here, it's a bit rich. And I like Canadian Natural Resources, but I like that my energy is market cap weighted. So at least the energy stocks are lower weighted, whereas in XDIV, you're getting kind of an equal weighting, because you can see Suncor Energy I'd be a little fearful of, at an 8% weighting. Enbridge is a little sketchy at a 9 or 10% weighting, because again, if energy gets hit hard, Enbridge could still get hit a little bit. But again, I'm not saying this is a bad ETF. It's good to cost average into this. I'm not trying to fear you away from it. I would just be aware that, again, growth in these stocks might be unwarranted for the short period of time, which could open up a good buying opportunity. Just be a bit cautious. But yeah, we'll see what happens with Take Two. Again, I think 30 to 300% is actually unreasonable. I really don't. We'll see what happens. Like I said, I don't know what else to say about Take Two. I want to do more videos on it, but like I said, if you go on YouTube and you look up Take Two stock, like 2 of my videos are like some of the top 5 ranked videos. Nobody talks about it at all. I'm shocked at how little people talk about it. And I'm excited to see what their earnings are like too. I mean, we'll see how Take Two is doing, or 2K is doing. A lot of people I see playing a lot of the sports games right now, like Dr. Disrespect's really big into 2K golf. So we'll see what happens. Why not just put XEQT into a VOO or VDY, or just buy international ETFs to avoid any of the overlap? Yeah, you could do that. But honestly, I just don't want that much international exposure right now. I just, a lot of people like it, but look at the performance of VT over US stocks. I don't think we're at the end of the cycle of US tech. I know a lot of people like Strongman, and I see a lot of people, honestly, since I've been investing, the best possible trade you could have made, and the reason that I made so much returns, is because I focused on US tech for the last 10 years. That is where almost all of my gains have come from, with the exception of a few small caps that also helped skyrocket. I mean, I made like 500 or 600% on Apple. I was in Apple so early, Microsoft, Meta did so well for us. I mean, and I just don't think that trade is dead yet. I think for the next 10 years, you're still going to be like, oh man, why did I focus on so many other things when tech was where all the growth was? Because Pepsi's not going to, when you go 5-10 years out, people aren't going to think of Pepsi being the growth beast. It's going to be Google, Meta. It could still be Tesla if Tesla actually innovates and somehow makes a robots usable in the next few years. I mean, God knows, right? Tech is still where all the money's at, even crypto, right? If we see crypto evolve the way it should be evolving. Yeah, CNR, again, it's the division between CNR is, again, a traditional foundational company. It's more of a Warren Buffett styled company, I think. These aren't companies that I think of for growth, though, right? I even look at, for example, I think a good comparable, if you're Canadian, to see why the growth just isn't in these kind of companies is this is why I like doing comparables to benchmark ETFs like VCE. So if you look at VCE, this is what most people should be buying if they want Canadian exposure. VCE is basically just the Canadian market through a market cap weighted ETF. It's the VOO of Canada. And if we take a look at the holdings, as an example, Royal Bank is 8%, Shopify, Toronto Dominion, Enbridge is in here, Brookfield. There's your Canadian Pacific Railways. You get your tech and everything in here, which honestly, I think most of the Canadian tech companies are highly overvalued. I don't like holding them. I think they get way too rich way too quickly. I don't know why Shopify got so expensive, became a bubble, bursted, and is now trading at rich values again. I just don't understand it. But if you look at the growth rates on this, which I find really interesting, let me just pull up the fact sheet real quick. What's really interesting about this, if you zoom in and take a look here, you can see that since inception, and this stock has been around just about as long, I think, as VDY has, but since inception, I mean, you're talking about a return of 9.18%. So let me just pull up VDY real quick and just show you. Actually, I have it right here. Let me just show you the comparable real quick. So if we go to VDY, we look at that fact sheet and just do a quick comparable. The return has actually been slightly better in VDY, because you can see it's 9.9% since inception. So, I mean, If we has VCE been around just as long? Let me just take a quick look here. How long has VCE been around versus VDY? So yeah, I mean, this came around in 2011. It literally almost the same time VDY. How long has VDY been around for? VDY has been around, yeah, pretty much the same time. Like there's a year difference. So these two stocks I think are really interesting, and you got to ask yourself, with all the tech exposure, all the Canadian National Railways, all these stocks that look like they had great growth, that are market cap weighted, how because VDY as a market cap weighted dividend stock made up better performance than the Canadian market. And the only reason I can think that it's outperformed is because of the banks. Canada, I think, overvalues its tech way too much. It gets way too expensive. And our financial institutions have been incredibly valued. They've been very fairly valued. They've been the best growth driver in this economy. They have the best performance over all the other stocks. So I'd rather be concentrated in the best companies in Canada. And I think I get that exposure through VDY. And I'm still a total return investor. And I just don't think Shopify deserves the value it has today. So why would I want an exposure to companies where I don't think the best growth is, right? So when I look at Shopify, I mean, this thing's trading at a 62 times multiple, and it hasn't been able to peak all-time highs, and it bursted by 80% because it was a bubble. And it's moving back into bubblish territory. This is why I think the broader Canadian sector is underperformed, because all our tech companies, our largest companies, are overvalued. Look at Constellation Software. This is one I've never been able to wrap my head around. I mean, this is a company that trades at 100 times multiple. I mean, I can never wrap my head around how these companies got up to the levels that they got up to, and can this sustain? And typically these do not sustain over 5 or 10 year periods, right? I mean, look at the last 5 years. You think this is going to happen for the next 5 or 10 years? Maybe. But I don't trust the growth that it offers. So, I mean, what is even Shopify doing? Let's just take a look at Shopify again real quickly. Shopify revenue. Let's take a look on macro. I know it's kind of getting back into some good growth because they cut off the weak parts of their business. But yeah, I mean, the company, yeah, they're not doing bad, right? They're growing at a 30% clip. But then again, so is Meta. I mean, Google's growing at a great clip too. So, I mean, like, do I want to pay, again, a pretty high multiple for this? I mean, it's questionable. It's a great company. Don't get me wrong. Let's take a look at the net income. Yeah, the net income is starting to recover, right? So this is probably what's driving some of the stock performance. But so $2 billion, is that the annual? Yeah, I mean, their annual run rate is $2 billion. Whew. I mean, $2 billion right now for a company that's worth $174 billion is kind of crazy to me. This is the same problem with like Palantir, right? But even Palantir makes Shopify look cheap. But yeah, I don't know. Like I said, so I like VDY still. I still like the upper weighting in the banks. So I'm happy with it. I've held it for a lot longer than I've held SCHD for. So I don't know. I don't have any reason to get rid of it, and I don't want to hold XEQT because I still think I'll get better performance. Like, what's XEQT? Let's just take a look and see what the comparable growth rates are. Like I said, I want growth, right? Like, so why do I want to diversify my way out of growth? Since inception, actually, XEQT's done a great job, 11.91%. That's pretty good, actually. It's really, really good growth. But we'll see what happens. This is why I'm picking individual stocks with the S&P 500. Because, man, the S&P has done exceptional. What's the growth on a VOO right now as an example? I don't want to own the Qs because I think the Qs are a little concentrated, and I'd rather concentrate Google in that stuff. But let's just see what VOO, where's the growth rate on this guy here? Yeah, 14%, right? So if you concentrated in VOO since 2010, I mean, the 14% growth rate is quite astounding. Versus, I don't know what the comparable 5-year. Yeah, I mean, even the 5-year, right? I mean, 5 years has been 18% on VOO, and on XEQT, it's been about 15%. I mean, these growth rates are insane. I don't think we're going to get those kind of growth rates in the future, but I'd still rather be concentrated where I think the growth is going to be. So like I said, I think I've set up the way that I'm comfortable, but that might change in the future. Who knows? Who knows? In my TFSA, I am all in QQQ tech. It is the future. I'm ready. If you're a young man, there's nothing wrong with it. Cost average might not be the worst decision. What about SMH? I missed that boat. I don't, they're cheap now though, I think. What's the ETF trading at? Honestly, like the whole chip sector crashed. It seems to be trading pretty cheaply today. What do we got here? What's it up? Yeah, I mean, from all-time highs, how much is this down from 2024? It's still down about 24%. So it's lost half of its market cap value. And honestly, like, I was never the biggest fan of NVIDIA, but it, you know, if it keeps up here for the next few years, it is looking pretty cheap. TSM is looking pretty cheap again. I don't know about Broadcom. ASML is looking reasonable here. I think there's a lot of the trade wars that are affecting these as well. But what's TSM trading at right now? I mean, it was looking pretty cheap last I looked at it. Yeah, I mean, for the growth it's giving out, it's trading at a 21 PE here. It's dropped off probably about 25%. Let's take a look at the revenue real quick. I think the revenue on this sucker's been pretty nice, hasn't it? Yeah, I mean, it got back into a crazy growth phase here, like 20, 50% growth rates. Whoo, baby. Yeah, I mean, TSM is looking even better than Shopify is right now, in my opinion. Yeah, I mean, buying the semiconductor ETF, if you want some concentration and some growth, yeah, I mean, it's not the worst sector allocated ETF, which again is why I like the S&P, because at least I get NVIDIA exposure regardless of how I feel about it. I wish I could reset my TFSA. I bought too many weed stocks back when I was a noob and decimated my account. Sucks, man. How much did you lose? That's the scary thing with the TFSA, right? Like you want the growth, but you're scared of the losses, because if you lose the money, you can never get the growth back. And the other thing that really freaked me out is I was watching some videos and reading into it. Apparently, you're not allowed to hold OTC stocks in your TFSA, which is quite concerning for me, because like I was surprised it never got audited or taxed on some of the gains, because I made a lot of my Canopy Growth Corp gains in my TFSA. Now, keep in mind, it did become a major listed stock, I think, when I sold it. I'm not sure, but I'm really perplexed because some of the rules on the TFSA are a little bit more in depth than even I thought. What do you think of TEC? Was going to start buying, just wasn't sure if it's to focus on VFE. What is TEC? Let's take a quick look here. TEC. The TD Global Technology Leader. Yeah, I think you recommended this, or somebody mentioned it on one of my videos. And honestly, it's probably not the worst stock you could buy. I think VOO for me, again, is just easier because I don't want heavily concentrated in tech companies, because I think some of them are overvalued. So that's why I don't buy the Qs. There's nothing wrong with buying the Qs and cost averaging if you've got a long time horizon. But again, like I want to be financially set in the next, realistically 3 to 5 years, but I don't mind waiting a bit longer. But in the next 3 to 5 years, I'm just asking myself continually, what's going to get me there in the path of least resistance? So I would rather just cost average into VOO, forget the Qs, because I don't want that concentration in Tesla. I'm still a bit hesitant over the next 5 years for NVIDIA. I don't want Costco. There's a lot of stocks like Apple that are heavily weighted in the Qs. I would rather overweight my own. That's why me and my wife made our own QQQ ETF. I would just rather own the S&P and then upperweight the handful of tech stocks I truly believe in. But if we take a look at this is basically just another version of the Qs from my understanding. Where are the holdings in here? Let me just pull them up real quick. Where are the holdings in this thing? Historical performance. What do we got? U.S. equities, 86%. Oh, did I pass it? No, right here. Yeah, so 12% Apple, 11% Microsoft, NVIDIA at 9. So this is just another version of the Qs. You got Tesla, NVIDIA in here. It's not a bad ETF. If you're young, this is a great ETF to hold long-term if you've got like a 15, 20-year time horizon, right? Again, these are not bad ETFs. I'm not trying to steer you away from them. However, I would recommend the Qs over this because this has a very high management. Not that high, but 0.4 seems pretty high to me. I mean, the QQQ ETF has what? I think their management fee is significantly lower than that, isn't it? Let me just take a quick look here. What are the fees? Yeah, 0.2%. So you're about 50% less on an expense ratio. So I would rather hold the Qs than probably that ETF, just to save yourself a bit of the expense ratio. I got a shitload of it. It's better than QQQ. Yeah, I'm down 87 grand in my TFSA. Only hope is Tilray's coming back one day, and that's in the US. Yeah, that's crazy, man. Whew, painful. It's a good learning lesson for sure to not overly concentrate. Well, how is Tilray been doing? I mean, the MJ stocks are getting pretty secularized. There's like a handful of them that are starting to show some resilience and starting to prove they can get a foothold in the MJ markets. But I have not paid that much attention to it because the competition is so tight. RioCan will get affected in earnings with Hudson Bay. Yeah, I think they're 3% of RioCan's entire portfolio. We don't hold the RioCan anymore. I convinced the wife to sell it a little while ago. She did make a pretty good return because we were buying RioCan at the bottom of the pandemic. I sold it a while ago. The wife sold it, I think, in the last 6 months or something, as we kind of more concentrate into our ETFs. But yeah, I mean, it's 3% of their portfolio. I still think RioCan's cheap. I think most of the REIT sector is cheap. I think if you're in retirement and you're looking for income, I mean, the real estate has been in a complete recession from the stock perspective. I mean, look at most REITs. They're just in the toilet. However, I would probably buy them through an ETF, but RioCan I still think is a great company, has a great balance sheet. They've really cleaned it up since the pandemic. And regardless, if they lose Hudson Bay, who cares, 3%. They'll replace it, I'm sure. What would you buy cybersecurity stocks right now? No, I think I'd rather own the big stocks because Google, I think it's Google or what company bought into cybersecurity recently. I mean, there's the mega cap companies are cybersecurity plays, right? So I don't want to worry about the lower ones because the mega cap ones, tend to play into that space pretty well. Or was it Microsoft? One of them bought recently a major cybersecurity play. Yeah, man, AI data centers run on coal power. Yeah, I really still like, I think a company that's trading pretty, or is looking more reasonable now is what's the, Sam Altman just left their board of directors. What is, why am I blanking on it? What's the modular reactor play that Sam Altman was on the board of? That one's tanked miserably after that IPO, and that one could be a reasonable, speculative uranium play right now or nuclear generation play. Yeah, Oklo. I was thinking, I had it in my head. I was like, is it Oklo? How is Oklo doing? Take a quick peek here. Good old Oklo. I've been following this from the start. I just didn't want to buy it because obviously it got way too expensive way too quickly. But yeah, I mean, the power generation, like the utility ETFs are great. Like, honestly, I would even forget Oklo. I used to own Southern Company, and my wife used to complain because she thought it was a boring company, but I'm kind of regretting that we sold it because it's the two best companies you can buy for power generation in the United States is Southern Company. It's been one of the best dividend stocks you could have possibly bought along with Duke Energy because it gives you that exposure to nuclear power as well. And I really like these two energy companies. They've been some of my favorites. I wish I held on to it, but whatever. Because I always feel like if you can buy the right utility company, you're basically buying a diversified utility anyways. You don't need to buy a sector ETF because Southern Company basically is a huge part of the sector. It's $100 billion. So it's a cool ETF as well. I took a big gamble on AAZ a couple of years ago and still waiting for them to get their asses in gear and find some damn uranium. I think what we're waking up to right now is a huge reality that, stocks can be crazy. I think this market environment's wild. It's, to see like United Health go through what it's going through and people still be bullish on it is crazy to me. I couldn't touch that with a 10-foot pole, though I do have exposure to it, I guess, in the S&P. You look at Tesla right now, people are excited he's leaving Doge. It's like the guy clearly has minimal focus on Tesla. Like, it is not his biggest concern. I just, the shit people discuss in the market environment today makes no sense because fundamentally it's like, fundamentals don't matter. They just don't, which is why it's kind of a defining factor that we're probably in somewhat of an overvalued market still, which is concerning, but we'll see if we made the right choices, boys. We'll see if my overvalued Take-Two Interactive and my video game stock and Google can outperform the broader markets this year, and we can reign supreme and continue to say that we are outperformers. We did it for a decade. Can we do it for another 5 years? Time will tell. Or do I get kicked in the bag and have to work for a bit longer before I can reach my financial independence numbers? That'd be another fun video. Maybe I should do a video on my financial independent numbers. That could be a fun video. I think it's good to set your goals and figure out where you want to be and get those time horizons and use a compound calculator. That could be a good learning lesson for a lot of you guys because you want to figure out what stocks safely with the path of least resistance can get you to your goals. And that's a really big word that I want to say, path of least resistance, because a lot of people think, I need growth. I'm going to run to speculation. And they're going to run to high growth stocks like Tesla, but they don't understand the risk that they're taking. And that risk isn't the path of least resistance. You want the lowest risk with the highest growth capable without taking on, again, like extreme risk. So it's a fun way to think about the market and how you invest. Do a video of getting kicked in the bag. This isn't, old YouTube. This isn't 2015, 2010 YouTube. Man, the shit we used to see on YouTube growing up. The funny thing right now is me and my buddy joke that Facebook is still the Wild West. Facebook is what YouTube was back in the day. YouTube is really clean. TikTok is really clean. But the shit me and my buddy find on Facebook, we actually send ourselves stuff back and forth because we're like, can you believe this is on Facebook? Like cartel level shit. And it literally within a day or literally 5 minutes of usually us sending it to each other, it gets removed. But Facebook has the raunchiest, craziest videos I've ever seen. And I'm like, man, Facebook is still living back in the old YouTube days to some extent. I was going to add Take-Two, but honestly, I think I missed the boat. I'm still holding it. I'm not a stock advisor telling you to buy Take-Two right now, but I think it's going to be somewhere between, if I had to guess, I'm hoping Take-Two ends up being a $400 to $600 stock. What's it trading at right now? I think it's at, what's the valuation? I think we're sitting at like a $37 billion market cap value. I figure if we can get down to getting about my thought is once Grand Theft Auto comes out, I don't think it's unreasonable for them to be generating about 3 to 4 billion in bottom line for a quarter or two. I think they're going to start becoming cash flow positive by a few billion. That'll give them about a 10 times value right now. And I think they'll be trading at probably a 20 to 30 times value. So it put their market cap probably closer to somewhere between 60 and 70 billion, if I had to guess. So it's not unreasonable, I think, for the stock to be trading at like 350 to 400 bucks a share. I think that is presuming that my speculation is correct. And, GTA 6 is going to generate, probably between $5 and $10 billion. And it's going to bolster their bottom line between somewhere to 3 and 5 billion. Again, analysts think that GTA is going to generate 3 to 4 billion in revenue over the whole year. I think in the first 3 months and within the first month, it's probably going to sell 30 to 50 million copies. It's going to sell for $100 or more. It's going to be the most expensive game ever sold. And yeah, I think it's going to make probably 5 to 10 billion in revenue. It's going to blow past analyst expectations. And off that revenue, they're probably going to cash flow somewhere between 3 and 5 billion. That's including the money they're already making, right? So they should be able to get, if I had to guess, somewhere between 10 and 15 billion in annual revenue. So I think the stock's cheap. I could be wrong. Tell me I'm wrong. I mean, it could be. I'm making a big speculation here, folks. The childhood video game nerd inside of me comes out, and it's like, and then the older, nerdier math person of me comes out, and it's like my childhood meets my adulthood, and can it explode into thousands of dollars? That's the game we're playing now. Anyways, folks, stay cool, stay awesome, and as always, I look forward to catching the next one. Go vote. Tomorrow's voting day. Let's see how this works out. Peace.